You hear about them all the time in the news. Interest rates are going up, they're going down, but what are they really? Welcome to The Explainer, where today we're going to pull back the curtain on the one number that quietly runs your financial life.
I mean, think about it for a second. How is it even possible that one little number, decided by a small committee, can literally change the cost of a mortgage, a student loan, and even the groceries you buy? Well, we're about to connect all the dots for you.
And to do that, we're going to use a really simple metaphor. Just imagine an interest rate decision is like a stone being dropped into a calm pond. We're going to follow that ripple as it spreads out wider and wider until it finally washes up right at your feet.
So, here's how we'll track it. We'll start at the very center of the system, then watch the first ripple hit the banks, the second ripple hit the whole economy, and the final ripple, well, that's you. Then we'll see how the pros try to predict the weather.
Okay, let's get right to it. Where does this all start? Who's the one actually dropping that stone in the water?
Right at the heart of everything is an institution called the central bank. You've heard of them, right? In the US, it's the Federal Reserve, or the Fed. In Europe, it's the European Central Bank. Their whole job is to keep the economy on an even keel, making sure prices are stable and the financial system doesn't, fall apart.
The way they steer the ship is through something called monetary policy. Now, they have a few tools in their toolbox, but their biggest, most used one is the power to change the key interest rate. It's the main lever they pull to control the entire economy. And this is it. This is the stone. It's often called the base rate. It's the interest rate that the central bank charges to lend money to the commercial banks, the ones we all use. This single rate sets the fundamental cost of money for everybody. It's the bedrock.
All right, so the central bank has made its move. They've changed the base rate. So what happens next? Well, that single decision immediately starts spreading, and the first place it hits is the banking system.
You can see the chain reaction right here. The central bank adjusts its rate, which means it now costs the big commercial banks more or less to borrow money. And what do? They pass that cost along to us. It starts with the prime rate, which is what they charge their biggest, best customers. And from there, it just fans out to everything else. Mortgages, car loans, you name it.
So, that first ripple has moved through the banks. Now, it's about to hit the much wider ocean of the main economy. Let's zoom out and see what this means for jobs, businesses, and the prices of everyday goods.
And you've got to remember what the central bank is trying to do here. It's all about this delicate balancing act. On one hand, they need to keep inflation, that's the speed that prices go up, under control. But on the other hand, they want the economy to keep growing and creating jobs. Interest rates are their number one tool for trying to get that balance just right.
So they basically have two main plays. If the economy is running too hot and prices are rising too fast, they hike interest rates. That makes it more expensive to borrow money, which slows down spending and cools things off. But if the economy is stuck in the mud, they can do the opposite, sometimes using a tool called quantitative easing, or QE. That's a fancy way of saying they print money to buy a ton of bonds, which pushes longer-term interest rates down and encourages people to borrow and spend again.
Now, here's something that is absolutely critical to understand. The interest rate you see on an ad, that's just the sticker price. It's the nominal rate. To know what's really happening to your money, you need to look at the real rate, and that's simple. It's the nominal rate minus inflation. Think about it. If your savings account is paying you 3%, but inflation is running at 4%, your real return is actually negative 1%. You are losing buying power. And that brings us to the most important part, right? The final ripple, the one that actually reaches your personal finances. What does all this high-level economic policy actually mean for your savings account, your credit card, and your mortgage? Okay, so whenever you borrow money, the one number you really need to look for is the APR. It stands for annual percentage rate. It's not just the interest. It includes all the fees and other charges, so it tells you the true cost of the loan. It was basically designed to force lenders to be transparent so you can actually compare loans accurately. So when you're taking out a loan, you'll often face this big decision: fixed rate or variable rate. With a fixed rate, your payment is locked in forever. It gives you certainty. The lender is the one taking the risk that rates might shoot up. With a variable rate, you might get a sweet introductory deal, but you're the one taking the risk. If the central bank starts hiking rates, so will your monthly payments.
All right, for our last section, let's look at how the pros try to get ahead of all this. They don't just react to the ripples. They're constantly trying to predict where the next stone is going to drop. It's like being a financial meteorologist.
And one of their most important forecasting tools is something called the yield curve. It sounds complicated, but the idea is pretty simple. They look at the returns, or the yields, on government bonds of all different lengths. By plotting those on a chart, they can get this amazing snapshot of what millions of investors around the world are betting will happen next with the economy.
But here's the thing. Markets aren't just driven by data and spreadsheets. A huge part of it is human psychology. And that brings us to this fascinating idea called the wall of worry. It's when markets just keep climbing higher even when all the economic news looks terrible. Why? Often, it's because everyone believes the central bank will ride to the rescue and cut interest rates if things get bad enough.
And that really leaves us with the final big question. We can understand the mechanics, right? We can trace the ripple from the central bank all the way to our own bank account. But predicting the next ripple? Well, that means you have to predict human behavior. That wild, unpredictable mix of fear and greed. And that is a puzzle that never, ever stays solved for long.